next thing that you need to understand is that when you sell a house for less than the face value of the mortgage that you took out against it, in other words, less than what your house you said you would pay the bank when that you bought it, okay? Because it's worth less on the market today. The difference between what you said you were going to pay and what you're actually going to pay is called a deficiency. How the bank handles that deficiency is 99.999% of the time today is they will issue a 1099 for the full amount of the deficiency in the next tax year, and they will forgive the debt. It's called debt forgiveness. How that the IRS handles debt forgiveness is something that you need to talk to your accountant about. Right now, in the last, since 2007, so that's 6 years, we've had an act that Congress enacted called the 2007 Debt Forgiveness Relief Act, which has allowed people to short sale their house and to write off the debt forgiveness to the IRS without having to pay tax on that phantom money that they never got, but the bank says they did, and the IRS believes they did. It's bizarre, but when that you take out a mortgage for $500,000 and you sell the house for $300,000, the IRS believes that you made $200,000 in income. Don't understand it, but it's a fact. And they will tax you on that $200,000 as if it's ordinary income, except for the 2007 Debt Forgiveness Relief Act, which now allows you to escape the consequences of debt forgiveness on your primary mortgage in certain circumstances. So for anyone thinking about entering into a short sale, the status of the 2007 Debt Forgiveness Relief Act is a very important item. And right now that act is slated to expire on December 31st of 2013. And our Congress, who currently right now can't even talk about whether they're going to fund the budget, do not seem functional enough to figure out whether they're going to extend this act or not. So if you are thinking that you may have to sell your house, and your house may not be worth the face value of the mortgage, and you're looking at debt forgiveness as a possibility, you need to have some sit down FaceTime with your accountant and go over all of the issues at hand to see what your tax liability is going to be. Now, if you're not talking about selling a primary residence, but instead talking about selling an investment property, and then the fact is that even if your bank gives you debt forgiveness on the amount they didn't get, which has been the case lately, which is very interesting. They are no longer holding the deficiency judgment against investors. The IRS feels very differently about it, and my understanding is that even though your bank is willing to forgive you, the IRS does consider that income, and so you may in fact owe money to the IRS for the debt forgiveness. So these are actually the most important things if you're thinking about doing a short sale that you need to consider, because the short sale itself is very straightforward with a very competent professional to negotiate for you in front of the bank. Depending on the bank, the loan, the value of the house, all that good stuff, I can practically predict the outcome. I've done so many of these. I can tell you how long it's going to take, what the resolution is going to be, etc. and so forth. But the accounting issue is well beyond the purview of my real estate license, and you need to talk to a professional about what your liability is going to be. And by the way, you will have the same liability with the IRS whether you go to a foreclosure or a short sale. But you know, what you will not have in a foreclosure is any control.